Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're looking at how investors can get the maximum income from their portfolio. This time last year, the Federal Reserve was promising several interest rate hikes through 2016, and the Bank of England looked set to follow. But then, the unexpected happened, and Britain voted to leave the European Union, sending the pound plunging and the bank into damage limitation mode. As a result, the Bank of England base rate was cut to an even lower record of just 0.25%. All hope is not lost, however. The FTSE 100 yields an average of around 3.7%, despite rallying 15% in the last year. And the US, Europe, and even emerging markets have well-covered dividends and investment-grade bonds for the discerning income investor. Let's kick things off with Emma Wall, Senior Editor for Morningstar.co.uk, and Ariel Bazzello, Manager of the Jupiter Strategic Bond Fund, as they discuss inflation and what this means for interest rates.
Hi, Ariel.
Hello, hi Emma.
So this week we're expecting inflation figures in the UK, and they look to be higher than they were in the previous month, in part due to rising oil prices. Now, this of course puts pressure on the Bank of England to raise rates. So what are indeed your inflation forecasts, and how do you think the bank will interpret them?
I think over the course of the next few months, we're going to see the inflation numbers ticking higher and higher. You mentioned the rising oil prices. Due to base effects now, that's going to push the inflation numbers higher. And in addition to that, obviously, you've had the sharp fall in sterling, which is going to lead to higher import prices and inevitably higher prices on the high street. At the moment, the Bank of England are taking the stance that this is somewhat transitory and they want to try and look through this. But at the same time, the surprising thing for the UK economy is, it's kind of been a question of Brexit. Well, what happened? What Brexit? Because the data at the moment for the UK economy is pretty strong across the board, quite literally. So you've had a number of members of the MPC now who are actually toying with the idea of raising rates. And if we start to see inflation numbers tick high, you could actually start to see them move on rates in the coming months.
So what are we talking here? Is it going to be 2%, which is of course the target, although it's been a long time since we've had 2% inflation, or is it 3 or even 4% for the UK?
You could see us go comfortably above 3% over the next few months. And in the past, under Mervyn King's governorship, the Bank of England were quite happy to look through that, and we had ongoing letters between Mervyn King and the Chancellor. Mark Carney seems to be very much in that camp, and as I said, seems to think that these things are transitory. But I think there are a number of members out there now who are beginning to put pressure to start raising rates.
And of course, higher interest rates is great news for savers, and it's great news for people who are buying a bond at that issuance. However, for those who already own bonds or are trading bonds, of course, higher yields means lower prices. So what does that mean for you as a strategic bond fund manager?
So over the last year or so, and this is not just a UK phenomenon, we are seeing a reflationary picture developing globally. A lot of it coming from the Far East, a lot of it coming from around Europe on some of those base effects related to oil. And then obviously we've got President Trump, who is now talking about aggressive stimulative policies, which inevitably will lead to reflation. So there is very much it's not just about the UK, there's very much this global reflation trade going on that's bidding up commodity prices, that's bidding up risk assets in general that are very much linked to a cyclical uptick in economic activity. So with that in mind, in our portfolios, since the summer of last year, on the back of a number of these concerns, we have aggressively reduced the interest rate exposure of the fund. Basically, we've cut the duration of the portfolios. And I think that's the right way to be positioned tactically, probably for the short to medium term.
And of course, you delivered 7.5% to investors in 2016. That looks pretty attractive, given if you have a look around at the government bond yields available to investors. Is that the sort of thing that we can expect again this year, or do environments become more challenging?
Well, I think for a number of the reasons we've spoken about already, it's going to get harder and harder for bond investors, undoubtedly. And that means we have to work harder and spot those opportunities. And the great thing about a strategic bond fund is we have that flexibility to go out to some really interesting, weird and wonderful places to find those returns. So we're venturing out a lot more into emerging markets, as well as delving into parts of high yield in Europe and the US to get those returns. But yes, undoubtedly over the next 12 months, it's going to be harder to achieve similar returns to what we did in 2016.
Ariel, thank you very much.
Pleasure, thank you.
If you're new to investing, then we're here to help. Listen to our next piece where we find out exactly what a stock is and the risks and benefits to investing in them.
What is a stock? In exchange for cash, an investor can buy a proportion of a company, called a stock or share. If the company does well, the share price will go up, and the shareholder can crystallise this gain by selling the share. If the company does badly, the share price will fall. This is the risk of being a shareholder and having what is known as equity investments. Companies with spare cash will often choose to reward loyal shareholders with a payout known as a dividend. Large, cash-generative companies pay a regular dividend, either once, twice, or 4 times a year. If one company buys another or sells off some assets, it may pay a one-off special dividend.
Up next, Fidelity Special Situations Fund Manager Alex Wright picks 3 undervalued stocks at an attractive price, which also pay out more than the rate of inflation.
Hi, Alex.
Hi.
So what's the first stock you'd like to highlight today?
The first stock I'd like to talk about is Shell, the oil company. So this is the largest stock in special situations today, about a 6.5% position. And the key reason I like it here is the sustainability of the dividend yield. So this yields about 6.8% today, is one of the biggest dividend payers in the market. And I think that dividend yield is very sustainable at $55 to $60 oil, which is where we are today. And additionally, there's a lot of production growth coming through primarily because of the BG acquisition, and that is production at very low prices. So effectively, the cost of that production is very low, and so earnings for Shell are growing over time, irrespective of the oil price, given that growth coming out of the Brazilian assets of BG.
And what's the second stock today?
Second stock I'd like to talk about is Royal Mail. So this is about a 3% position in special situations today. I think the key attraction of this stock is, first of all, a lot of people miss, but this is a regulated utility, and the regulator is charged with maintaining a 5 to 10% margin for the company. So while there are a lot of moving parts over time, actually this is a company that should consistently be able to do that. Today they're only doing about a 5% margin. The valuation of the stock on that low margin is only about 10 times earnings, about a 5.5% dividend yield, and I see certainly over the medium term them consider being able to continue to produce these sort of profits that they do today.
So utilities generally tend to kick off a nice looking dividend yield but not much share price growth. Is that fair for Royal Mail?
So I think Royal Mail sort of standalone is unlikely to produce much top-line growth, but in terms of efficiency, I think there is a lot of a scope to improve the efficiency. So that 5% margin is the lowest of any postal name in Europe, and I think that is a legacy of the fact that they were privatised a lot later than any of those names, and therefore there's more scope for them to invest and improve margins over time. And clearly the fact that the bottom end of that regulated 5 to 10% band shows the potential that if that really works out well, over maybe a 10-year time period, you could double profitability.
And what's the third and final stock?
The third stock I'd like to talk about is Ultra Electronics. It's a mid-cap FTSE 250 stock, which primarily plays to defence end markets. A company that really has lost its premium rating due to some prior contract issues in Oman. I think those are now past it. We're seeing a much better defence environment with growth, particularly out of the UK and US budgets, and increasingly from the Middle East and other NATO partners as well. And they also have a big simplification programme, which is improving margins and synergies coming from a recent acquisition.
You said the keyword NATO there. I was going to ask how sensitive to geopolitical risk is this stock, meaning particularly the Middle East. But the thing about NATO is we now got Trump in the White House who's threatening to leave this, that and everything. Do you worry about that sort of thing with this stock? You know, the threat of kind of geopolitical risk either from the US or indeed the Middle East?
I think basically, geopolitical risk is generally positive for defence spending, and I guess more uncertainty creates more desire from countries to spend. So particularly with Trump talking about maybe not honouring NATO commitments, that clearly pushes sort of NATO members to want to spend more on their own defence if they're worried about the US sort of not stepping in to support their aims. And the US itself, as obviously the biggest defence spender in the world, is committed to spending more themselves. So I think if the current environment continues, it's a reasonable demand outlook. There is the possibility that those events may push that to be a very good demand outlook.
Alex, thank you very much.
Thank you.
Going back to basics, we now know what a stock is, but what exactly is a bond? If you're new to bond investing or have held fixed income funds for some time and just need a refresher course, then listen up for all the information that you need.
What is a bond? A bond is an IOU between an investor and the bond issuer. The investor lends the bond issuer a set sum of money in exchange for a promise to pay back the lump sum at a pre-agreed date in the future and regular interest payments throughout the term of the loan. Bond issuers can be companies or governments. Generally, the less financially stable the bond issuer, the greater the interest payment. For example, the US government would pay a smaller rate of interest than a company in a developing economy. If you buy the bond at the date of issue and hold it for the duration of the loan agreement, the interest rate is called a coupon. Much like shares, bonds can be traded between investors. The bond issuer remains the same, but the bond is transferred to a new owner who is then paid both the interest and, at the end of the term, the lump sum. The price of a bond is determined by the demand. While the coupon payment is a set amount of cash, because the price of the bond fluctuates in the open market, so does the yield when expressed as a percentage.
What does rising inflation mean for bond investors? Next up is bronze-rated M&G bond fund manager Richard Woolner, who explains how macro factors such as rising inflation can influence his investment process.
Hi, Richard.
Good morning.
So we've heard today the January inflation figures in the UK, 1.8%, a little lower than we were expecting, but still an increase on the previous month. Now, you, unlike some other fund managers, are really impacted and indeed guided by the macroeconomic factors when it comes to investment decisions. So for you, how important is this latest inflation figure?
Like all trends, you're trying to see what's happening next and where markets are going. And it's just a signpost. It's a signpost that we're at full employment. It's a signpost that the economy is strong and will probably remain strong all the way through to, it's still 2 years before Brexit presumably formally happens. In those 2 years, we have the benefits of a very loose monetary policy set by the Bank of England 6 months ago. We have an exchange rate that's very, very low that encourages growth and imported inflation. And we have full employment and strong credit growth, whether it be car sales or the general housing market. So, it's a signpost that inflation is coming back. The question for me as a fund manager is what's priced into the market? And bond yields are still very low in the UK. And therefore, for me, it's a signpost that inflation's picking up and you need to be defensive in terms of taking interest rate views.
And this is not just a UK solely phenomenon, is it? We've seen inflation figures in Germany and across the EU and indeed in the US start to pick up. You say it does impact then your asset selection. Does it force you to have to think, beyond the sort of obvious picks in this kind of market cycle?
As always, you're always thinking about that, where inflation, where growth, where interest rates are going to be. In terms of expanding it out, it's trying to work out whether index-linked securities are good value versus government bonds. So back post when the events of the summer unfolded around Brexit, we changed our duration of our portfolio. We had a bias towards buying index-linked securities because we thought that inflation would pick up and the market hadn't priced that in for some reason. Those markets are now back to fair value. I think the main thing is just thinking about where the world economies are going. Are they healthy and strong, or are we on the precipice of the next recession? I think they are healthy and strong. We're not on the precipice of the next recession, and therefore we generally like to take credit risk because we think recession is unlikely. But we don't want to take lots of duration risk because we think that the economy is not as fragile as maybe the markets or the central banks think.
7.7% return last year for investors. Pretty good looking considering how low yields are across the developed world. Outlook for the next 12 months, can we expect more of the same, or is it a little bit more challenged now?
It's always every year. The good starting point is where the asset class sits and where it yields. And in order to add value, in order to do things to the portfolio, you need, a horrible thing to hear, you need sort of strange things to happen. You know, if the world was calm and stable, then you can't provide excessive returns. If the market panics and gets too excited, then what we can do as value managers is we can add value by not being there when the market's too excited and getting involved when the market's scared and panicking. So it depends how the market evolves. So if there are events over the year which cause markets to be mispriced, then we can add more value and returns to the portfolio. If the market is calm and benign, then that's a lot harder to add value to the fund.
And finally, will this higher inflation mean a rate rise in the UK?
Oh, I'm perpetually, surprised about where rates are. I think the Bank of England has got various measures it needs to do first. They've currently been buying back corporate bonds. That programme is way ahead of schedule, and I think that might come to a close soon as a signal that maybe we're going to put rates up. So I think it'll be a while before they do that, but they've sort of said what they're going to do because they fear what Brexit's going to happen. So it's very, very hard for them to reverse it. But the data, if you just sit here and looked at the data, you know, the Bank of England wouldn't be talking how they're talking. But when you look forward and they still remain very concerned about the events in 2 years' time, that limits their ability and their approach to put rates up. I personally would, but you know, they've got a more forward-thinking job maybe than I have in terms of seeing what happens with Brexit.
Richard, thank you very much.
Thank you very much.
Want to beat inflation? Then maybe it's time to consider equities, says Invesco Perpetual's Chief Investment Officer Nick Musto, who urges income investors keen to beat the erosive effects of inflation to look for stocks with growing dividends.
Hello, Nick.
Hello.
So we've heard this week the new inflation figures, 1.8% in the UK. Not as high as expected, but still higher than it was. Should investors be worried?
I think that inflation is one of those risks that's out there really for the medium term. I'm not sure whether the short term will actually play out, you know, with a much, much higher rate, but I think we're going to see gradually rising inflation over the rest of this year. The fact that we've had the currency weaken, we've had rising commodity prices, I think that stalls up an inflation increase.
And today, or this week, we are focusing on income. So how does inflation affect income assets?
Well, inflation is always the bogeyman for income assets. So if you're looking at fixed income, by definition, you see a fixed return in terms of your cash flow. And so inflation eats into that return. And so it's very, very important to find assets that will actually hedge against that inflation rise.
And indeed, for equities that have dividends or pay dividends, it means you're getting less of a real return if inflation rises.
It can do. The real trick is to find companies that are going to grow their dividends over time. And therefore, in a rising inflation environment, they have the ability to actually increase their profitability and hence their dividends, and thereby giving you a very good hedge.
And that was going to be my next question. How does an investor protect themselves from rising inflation? Because if it's going to continue to tick up, this is something we need to consider when constructing a portfolio.
Yeah, I think it's very important. I think we've had the last 5 or 6 years with very, very low inflation, in fact, deflation around the world. And I think it's a new sort of challenge for investors to find a way to actually protect themselves from it. I think investing in equities gives you a very good ability to do that.
Nick, thank you very much.
Could you live on £25 a week? The average pension pot is just £25,000, buying you a weekly income in retirement of just £25. David Ard, Managing Director of Investec, is up next speaking to Emma Wall to discuss how to maximise your lifetime savings and make them go further.
Hi, David.
Good morning.
So it's Income Week, and today we're talking about income and retirement. I thought we'd start with a bit of a shock tactic to get people in the mood. Average pension pot, £25,000 or thereabout. What kind of income in retirement would that provide?
Well, we've seen annuity rates fall to around 4% for a single life annuity. But if if we look at what markets potentially and money managers could potentially generate for clients, then let's anchor to 5%, which I think is an achievable, still quite hard to get, but an achievable income level. So 5% on 25,000 is going to give you £1,250 a year. Just over £100 a month, or just over £25 a week. There aren't many people that I know that can live on that.
I certainly would struggle on £25 a week. So hopefully that kind of shock tactic has encouraged people to save more. Let's delve a little bit more into that 5% figure, because to me, when you're looking at, you get 1% from cash on the high street, the Bank of England base rate is still 0.25%, although it may rise this year. 5% seems pretty punchy. Yeah, now 5% is a good point to anchor to, but it's still quite a challenge and a stretch to get there. I think if you look around the world, and much like, our forefathers travelled the world trying to explore new lands, new promised lands for spices and silk and whatever else. I mean, today, I think what we're doing as investors, investment managers, is we're travelling the world trying to find alternative sources of income that carry some risk, but there's no free lunch in society, as we know. And so if base rates, as you rightly say, are 25 basis points or 0.25%, how do we get to 5? Well, UK equities and global equities could give you somewhere between 2.5 to 3. High-yielding corporate bonds, which are not, in certain cases, particularly risky, may give you 6. Emerging market debt might give you 8. Infrastructure, as most governments are rebuilding their roads and rail networks, can give you a very sustainable conservative yield, and property to a certain extent. So there are many sources of income that can help you, the investor, get to 5%. I suppose also the thing to consider when you're in retirement and you are drawing an income from your investments is to focus on that income portion and to not be concerned about perhaps the capital underneath it, because some of the assets that you talked about there do traditionally have perhaps a higher risk premium than gilts or other government bonds where you may have previously been having your pension portfolio invested. So I think the answer there is really simple. If private clients are getting good advice from their advisors, it may well be that the right thing to do is to take cash from their portfolio every year, which is a mixture of income and capital. And there will be a gradual decline of their capital to potentially nothing. If the client is happy with that, then that's fine, and anyone that potentially looks to inherit something will be sadly disappointed. However, there are ways of just preserving your capital. I would say the better way would be to actually grow your capital at least in line with inflation, so the power of your money isn't eroded over time. And we certainly have got track records where we can refer back to keeping the capital value in line with inflation, as well as generating an income of somewhere between 4 to 6%. The real thing we must think about, if you look at the baby boomers and Generation X, one of the things they aspired to post the Second World War is a better health service, higher quality food, and a higher standard of living. All of those are actually leading to people living longer. So not only do we need more income to live on, but actually we're living longer. So I would definitely err away from capital erosion and towards capital preservation with a reliable and sustainable income level. That's the most important thing. David, thank you very much.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.